Hi, I'm Marcus and this is FinV. Today we're looking at Dropbox, ticker symbol DBX. So with more than 700 million registered users and 18 million paying users, Dropbox have become a leader in file sync and share. But the question is, are we seeing a growth slowdown? And there's a whole lot of focus and hope towards their new offering, which is currently in beta, that is said to solve the challenges users have with content scattered around hundreds of apps and browser tabs. And with a growing market, which they estimate to be worth about $7 billion today, and with the potential to more than triple over the next 4 years. Now, is that even realistic? And if so, should we be investing in Dropbox? Well, let's get to know their business. Dropbox provides a content collaboration platform worldwide. The company's platform allows individuals, families, teams, and organizations to collaborate and sign up for free through its website or app, as well as upgrade to paid subscription plan for premium features, and it serves customers in professional services, technology, media, education, industrial, consumer retail, and financial service industries. Now, let's look at the numbers. So, Dropbox is traded on NASDAQ, in the technology sector with a market capitalization of $8.3 billion and a revenue coming in at $2.5 billion. And looking at the historical development, we can see that the revenue have been improving on a year-over-year basis. But what is concerning though is that the growth rate is fluctuating, is all over the place. So there's not a clear guideline going forward. An investor does not like uncertainty, and this gives strong vibes of uncertainty. So that is something I'll keep my eye on. PE ratio, that is attractive, coming in at 18. And looking at the historical numbers, we can see that the PE ratio have been improving over the years, meaning that the market expectation of the stock is increasing, and also increasing the chances for us to see capital gains on this stock. So that is a plus. Profit margin at 18%, that is great. We can see that these numbers have been improving over the years. Fell off a bit in 2023, but overall development is positive. Price to sales ratio coming in a bit too high at 3.3. So they don't pay out any dividends, and looking at the return on equity tells us that they're not utilizing their equities efficiently enough in order to create profits. And we can see that these numbers have been dropping year over year, so this is concerning. Return on assets, on the other hand, came in at 7.8%, and these numbers have been improving over the years, so that is a plus. So the stock is currently traded at $24 per share. If you compare that to the 50 and the 200-day moving average, we can clearly see that we are below both the 50 and the 200-day moving average, indicating that we might see the stock price decline. And we can see here that we had been moving within a positive trend channel for quite some time before we got the earnings report and saw that analysts at Bank of America at JP Morgan lowered their forecast for the guidelines for the business, and we saw the stock drop from $32 down to $24 per share. But let's head over to the income statement. As we saw earlier, is that the revenue had been improving over the years, which is amazing, but the growth rate was all over the place. Looking at the gross profit, we can see that these numbers have also been improving year by year, which is amazing. What is concerning though, alarming, is that we see that the growth rate is diminishing rapidly. So this indicates that we are seeing a slowdown in the business. So the only way the business could improve these numbers is either increase revenues a whole lot, or find ways to become more efficient by reducing the cost of goods sold. But it is alarming to see that these numbers is declining, meaning that we are seeing a slowdown. Looking at the operating income, we can see that the research and development, they continue to invest in research, which is positive. We can also see that the selling, general, and administrative costs have been declining over the years, and saw an increase for the first time in many years in 2023. Now, the operating income have been improving over the years, but we saw with gross profit is that the growth rate is declining. So it is a bit alarming. Now, looking at the net income, we can see that the net income have been improving over the years. Fell off a bit in 2023, but overall change is positive, so that is a plus. Now, looking at the basic shares outstanding, they have been reducing their numbers of basic shares outstanding. We can see that the numbers of shares have been going down over the years, meaning that this company are doing buybacks. Now, should they be doing buybacks? Well, depending on who you are as an investor, but for me personally, I would like to see them halt their stock repurchase program, have that capital instead in order to invest in the business and find ways to increase their revenues, find new business opportunities, and maybe find ways to cut costs and improve their margins. So that's what I would like to see. Now, let's head over to the balance sheet. What I'm interested here is that the total current assets, which came in at $1.5 billion, compare that to the total current liabilities, which came in at $1.2 billion. Basically, if they were to convert their assets to cash, they're able to pay off the current liabilities and have around $300 million left on the table. So that is a plus. But at the same time, we need to take a closer look at the working capital to see how things have progress over time. By seeing that they have capital left on the table, that is a plus. Looking at the total liabilities, they are far from being able to pay off the total liabilities, but we are missing total liability data for 2023. But looking at the historical development, we can see that the total liabilities have increased over the years, but in between 2021 and 2022 the debt haven't been growing, so that is just amazing. I like that. Now let's head over to the cash flow, and we can see here looking at the cash flow, at the operating cash flow, it have been improving over the years, so that is amazing. That is a plus. Investing activities, we can see cash flow from investing activities have improved over the years, so that is a plus. And let's look at the financing activities here. We can see that the financing activities is actually declining, so this is a bit alarming. So I would like to see them halt, for instance, their stock repurchase program, like they spend like $539 million there, and so seeing that these numbers is dropping, they need to take actions here. Now the free cash flow, we can see here it went from 90 millions up to 759 millions, so these numbers have been improving. A small decline here in 2023, but overall trend is positive. Now let's head over to the key figures. Now we are lacking earnings per share, revenue per share, and equity per share, but as I mentioned, they don't pay out any dividends. This is a growth stock. But looking at the gross margin, we can see here not a whole lot of change, even though it have been improving over the years, so that is amazing. Great numbers. But as always, guys, we need to compare these numbers across the industry and see how the company is doing compared to the competitors. One thing I love about our software is that it is easy to compare the numbers. We have all their competitor in the same industry here, so we can just easily click on it. If we want to go through a bit deeper, we can only click on the show company and we'll load that business for you. So that is just amazing. So that is a plus, seeing that the gross margin is developing, is improving, even though it's not a huge change, but it's still moving in the right direction. Operating margin, it have been improving over the years. A small decline here, a small stagnation here, but overall these numbers is great. I like that. Profit margin, same thing here as we saw earlier, is that these numbers have been improving over the years. Fell off a bit in 2023, but overall trend is positive. Return on equity, as I mentioned, tells us about their business ability to create return on the equity we invest in them, and seeing that these numbers have been declining over the years, it is alarming. Now, return on assets have been improved over the years, so that is great. Looking at the financial strength, we can see that solidity have gone down, have been declining over the years. So this tells us about the company's financial strength for the long term, and seeing that these numbers is dropping, that is not good at all. That's negative. And balance sheet liquidity, we can see here that these numbers have been declining, improved a bit in 2023, but overall trend is negative. Basically, balance sheet liquidity tells us about the company's financial strength for the short term. And the debt ratio here tells us that it have been declining, which is plus. Basic tells us that the company has more equity than debt in the business, so that is a plus. And seeing that these numbers have been improving is I like that. Working capital, as I mentioned, we looked at the current assets versus the current liabilities. When we saw that we had, like, if they were to convert their assets to cash, they would and pay off the current liabilities, they will have like around $300 million left on the table. And this tells us about the difference of those two and how it has progressed over the years, and seeing that these numbers are stable. That is great. Capital turnover, not a whole lot of move. It is stable numbers. It basically measures how effectively a company uses its capital to generate revenue, and seeing that these numbers it is stable. So guys, we have gone through the income statement, balance sheet, cash flow, and the key figures. Now let's look at our key feature, which is the stock analysis tool. What it does is that it gives you a simplified, holistic overview of the company's performance, and it saves you a whole lot of time. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. We can, for instance, see that based on my profile, it gives Dropbox a FinVi score of 46, which is classified as weak. Now we don't have any common stocks data, and therefore we're not seeing valuation here. But looking at the price development, we saw that the stock price is lower than both the 50 and the 200-day moving average, giving us a score here that we might see the stock price continue to decline. And also it summarizes all the financials, so it is easier to grasp. For instance, we can right away see here that the PE ratio is below 20, the price to sales ratio is above 1, and also the revenue have increased over the past 5 years, profit margins have improved, profit increased over the past 5 years, and the gross margin, like it simplifies the entire process for you. And you can have this software, so just head over to finvi.io to try it out. Now, if I were to see, okay, we have gone through Dropbox, but is Dropbox the best performing business in this sector? And that is easy to find out based on my profile. Just click on industry and we can see the ranking here. We can see that Dropbox comes in at number 7. My personal thoughts, I think Dropbox is a great company with a lot going for them. I have personally used their tools and I'm fond of their work. I think Dropbox can be an attractive investment if they are successful with Dash. That could provide a great upside for investors if Dropbox manage to capitalize on Dash. A few things have caught my attention. If we look at the profitability, I do like the fact that the revenue have increased on a year-over-year basis and have a healthy margin that is improving. Looking at the gross, operating, and profit margins, they are efficiently utilizing their assets in order to create profits, and their numbers continues to improve. It's the guidelines that are concerning. Even though profitability is improving, the growth rate is fluctuating a lot, and the growth rate of gross profit, operating income, and are all pointing at growth slowdown, and that is alarming. Return on equity is declining on a year-over-year basis, which is a real turnoff. When the earnings report came out, the stock fell from $32 to $24 because of the guidelines. The market shared the same view. The slowdown is real. I for certain don't want to place too much hope that Dash can save the business. I think the work they have done in Q4 by optimizing payment processes, improve onboarding, improve the user experience, and reduce the user's lack of awareness of their other offerings can yield new sales going forward. I would like to see Dropbox cut their stock repurchase program and use that capital to improve their finances. Working capital is stable. They have more current assets than current liabilities, and their total liabilities are not growing in the same rate as it used to be, which is good. Their debt ratio shows that less and less of their assets are financed through debt, which is great. For me personally, I would wait and instead follow the company over a couple of quarters to see how things progress and see if the stock price continue to move to lower levels. When it comes to Dropbox, I'm not in a hurry to buy. That's all I have for this episode. I hope you have enjoyed this one. And if you would like to support the channel and the work we do, please give us a thumbs up, comment, and subscribe. If you have any questions or have stocks you would like us to take a look at, please let us know in the comment section. And I hope to catch you on the next one. Take care. Bye-bye.